I'm about to turn this news into a fresh, commentary-driven script you could drop straight into a video. I'm not rehashing the press release. I'm unpacking what NCP's collapse means, the bigger patterns at play, and what people might be missing. Let's dive in. The hook. Picture a well-known British utility of sorts suddenly grinding to a halt mid-road trip. A familiar name, hundreds of jobs on the line, and a business model built around the predictable rhythm of commuting and shopping suddenly feeling out of step. If car parks like NCP can't survive a post-pandemic shift in how we travel and work, what does that say about the future of urban mobility, property leverage, and the big players who claim to own the city's curb space? Context setup. NCP, founded in 1931, runs about 340 car parks across the UK, including airports, hospitals, and train stations. It has fallen into administration with 682 jobs at risk. PwC, the administrator, argues demand never recovered to pre-COVID levels, driven by changing commuting patterns and customer driving behavior. The company is burdened by long, inflexible leases on loss-making sites and can't service its creditors. The obvious move is to explore a sale as the best pathway to minimize losses for suppliers and landlords. Main breakdown. Let's unpack the core tensions driving this outcome, then layer in my take on what it signals. Core idea 1. Structural shift in demand for parking post-COVID. What I'm seeing, commuting remains bruised by hybrid work, online shopping reduces some in-mall traffic, and ride-sharing or micro-mobility options nibble at the need for fixed parking. NCP's administration cites a sustained gap between current demand and pre-pandemic levels, not a temporary blip. Commentary and interpretation. This isn't just about fewer drivers, it's about a shift in when and where people expect to park. If peak parking demand is attenuated and the cost of maintaining underutilized sites stays high due to long leases, the business model becomes unsustainable. What this matters for is the price signal it sends to property owners and city planners. Long-term, inflexible assets tied to fixed usage aren't as valuable in a world of flexible work and dynamic commuting. Why it's interesting, it foreshadows who benefits from flexible zoning, dynamic pricing, and airport hub opaqueness, where parking becomes a higher cost, lower priority service. If demand stays lower, we should expect site churn, consolidation, and perhaps repurposing of car parks for other uses. Bigger trend connection. This aligns with broader shifts in urban transport, where cities reallocate curb space to buses, bikes, and pedestrian-friendly zones, shifting the economics of private car storage. Core idea 2. The leverage problem. Long-term leases locking in losses. What I'm seeing, NCP's cash flow problems aren't just about fewer customers, they're about contractual rigidity. Long, inflexible leases prevent the company from cutting costs quickly or shuttering unprofitable sites, even when the market moves against them. Commentary and interpretation. This is a classic symptoms versus cause situation. The lease structure exacerbates weak demand, turning a temporary downturn into a solvency crisis. It highlights how capital-intensive, asset-heavy businesses can become trapped by their own real estate strategy. Why it's interesting? It's a cautionary tale for other operators with similar portfolios, especially in sectors where demand can swing with economic cycles or regulatory changes. If you can't outlast bad periods due to fixed costs, you're vulnerable to sudden downturns. Bigger trend connection. This feeds into a wider conversation about real estate as a financial instrument. The value of car parks isn't just about parking, it's about lease terms, debt covenants, and the potential to repurpose space as demand evolves. Offices, housing, logistics hubs. Core idea 3. The role of external pressures, energy costs, geopolitics, and growth bets. What I'm seeing, Park24, NCP's parent, points to higher energy prices since the Ukraine conflict as a cost pressure. They pursued expansion to grow revenue but still incurred structural losses, which means external cost shocks compound internal inefficiencies. Commentary and interpretation. When your operating economics depend on steady input costs and steady demand, shocks can push a vulnerable business from bad to broken. Their attempt to grow through new developments shows how revenue growth bets can backfire when the cost base or demand elasticity doesn't move in the same direction. Why it's interesting. Energy shocks aren't just about bills, they become strategic accelerants or dampeners for portfolio decisions. Do you double down on expansion or conserve cash and consolidate core assets? Bigger trend connection. This resonates with global themes of energy price volatility and the fragility of asset-heavy strategies in hospitality, retail parking, and even data centers under energy pressure. Core idea 4. Potential paths forward: sale, restructure, or liquidation. What I'm seeing, PwC says the best outcome is to sell the business as a going concern, preserving continuity for sites, staff, and customers while exploring all options with landlords and stakeholders. Commentary and interpretation. A sale could unlock synergies if a buyer sees value in the portfolio's locations, access points, or even re-tenanting opportunities. It also raises questions about what a buyer would do with underperforming sites: repurpose, reposition, or close. The decision will hinge on landlord cooperation, debt structure, and how much book value the market is willing to assign to aging assets. Why it's interesting. This isn't just about a brand going under. It's about the ecosystem around property assets adapting to changing mobility demands. A successful sale could catalyze a shift in how city assets are monetized and repurposed. Bigger trend connection. This mirrors a broader pattern where distressed industrial and transportation assets get reimagined through consolidation or alternative uses, rather than simply being liquidated. Deeper insight. What does this say about the city's parking economy and the future of urban mobility? My perspective. The NCP episode is a microcosm of a larger recalibration. Parking was once a stable revenue stream tied to dense urban areas and predictable footfall. Now, as work patterns, shopping habits, and transit mix evolve, the value of owning a large, fixed car park footprint declines unless you can diversify usage, reprice dynamically, or repurpose space. What many people don't realize is that the real drama isn't just the admin status, it's about what happens to the real estate underneath. If a buyer takes over, will they convert sites to multi-use hubs, warehouses for last-mile delivery, or even housing? The price of curb space is becoming a strategic lever in urban planning and logistics economics. If you take a step back and think about it, this is a test case for how corporate strategy meets city planning. Do you keep parking as a legacy, or do you adapt to a world where mobility patterns favor flexible, modular space usage? That decision ripples through land values, local employment, and the carbon footprint of commuting. Closing thought. Where does this leave drivers, workers, and city residents? For workers at NCP, the immediate concern is jobs and continuity. PwC says sites remain open and trading continues, but the long-term outcome depends on a buyer's vision and landlord terms. For drivers, price signals matter. In places with high per-day rates, there's an incentive to seek alternatives: public transit, car sharing, or even higher vehicle utilization to justify trips. The ultimate winners will be those who can adapt pricing to demand and convert underutilized lots into value-adding assets. For cities, there's a wake-up call about how curb and parking infrastructure is managed. If asset owners pivot to other uses, urban planners have to rethink density, accessibility, and environmental goals. One final, provocative thought: if a market-leading car park operator can't weather post-pandemic shifts, what does that imply for niche players in niche locations? The takeaway isn't doom, it's recalibration. The assets aren't worthless. They just need a smarter, more flexible, and more integrated plan to stay relevant in a rapidly changing transport ecosystem. If you found this breakdown insightful, drop your thoughts in the comments. Would you rather see older car parks repurposed for housing or logistics centers near transit hubs? And what should a new owner prioritize to keep sites viable in a post-pandemic, price-volatile world?